So Derek and I just sort of quickly give you some key pointers for the reporting season as we see it. Just start off with a look at the year that's just passed. We can see the first half of the year has really underperformed for healthcare. It did pick up in the second half, driven mainly by CSL, Cochlear and ResMed. But overall, it's been a pretty tough year for the sector. Just looking at some of the key themes and trends. Trump care has really created a lot of uncertainty in the US market, particularly across some of the large pharmaceutical companies. That has maintained and doesn't look like clearing up in the near term. Rising Australian dollar traditionally has been negative for the large healthcare stocks, but we do note that CSL and Ansell do report in US dollars, so the actual impact of the high Australian dollar is not as marked. We have mentioned recently that we are seeing a number of green shoots across the emerging healthcare space, and we're particularly interested in the digital healthcare space. So a number of our recent initiations of coverage and some of our existing stocks are in that space. We're looking for them to try and monetize a lot of the digital work that they're doing, and in some cases that's starting to bear fruit. Also, we've seen a number of changes in CEOs at the head of a number of the companies we look at. So Ramsay, Primary, Healthscope and Certex, to name a few. So that's also created some uncertainty. I've got a list of companies we're going to run through. I'll just start by having a quick chat about Nanosonics and the aged care sector. So Nanosonics, again, has been a very disappointing company for us over the last 4 months or so. Really underperformed. It was a high PE stock that's very much derated. The company's told us that they are looking for a weaker second half, so that's very much in the market, but we are looking for some strong guidance for FY18 to sort of reinvigorate buying into the stock. So at its current share price of $2.34, we do think it's good buying. The aged care sector has also been a difficult space over the last 12 months, particularly with a lot of the government cuts that are coming through, and they're really going to hit in 2018. So what's key for the sector is the commentary around the guidance for 18. We basically feel that the sector's in a bit of a trading range. So if there is weakness on soft guidance for 18 and share prices do fall, we'd sort of see that more as a buying opportunity because we think that, again, most of that weakness has been factored into the share price. So we've put out a couple of suggestions there. In terms of Japara, if it falls much below $2 around the reporting, we'd be buyers of that. But again, given it's in a bit of a trading range, we'd be selling above 220 if it recovers during the year. Regis, again, that share price has been quite weak. Around the 360 mark, we sort of see it as good buying. And again, in that trading range above 420, it's more of a sell. I'm going to get Derek to talk about the larger companies, but before I do that, I'll just make comment. We recently attended a conference over in New Zealand, and 17 days ago, we put up a list of companies which we thought were worth watching. So we put up 9 companies. We said that there's a lot of news flow coming out over July and August. Some of that news flow has already hit, some of it's yet to hit. Some of the performance of the stocks has been quite good. So of the 9 companies we called out 17 days ago, 5 have done well. In particular, Acrux and Volpara have posted some good results, and that's been reflected in strong share price performance. The disappointing one has been ImpediMed with a soft quarter. We've got them presenting at 2:30 today, so if you're interested in that stock, come and listen to that presentation. They've got some good news flow coming out for the balance of the year. But I might now just hand back to Derek, or down to Derek, to run through some of the other stocks in the sector to keep an eye on during reporting season.
Good morning, everybody. Let me just start at the 60,000 foot level here. Looking across the large cap space, we don't really expect surprises that many this reporting season. Really looking for earnings to come in line broadly with expectations. Having said that, a lot of valuations are quite toppy right now. I'd say the sector as a whole is trading at 1 standard deviation rich in both an absolute and relative basis. So if you remember last year, there was a lot of talk or a lot of prices were pushed up, and anything that had missed was actually brought back down to earth, or that gravity was pulled right back down. So these are the likes of the CSLs and the Sonics and the Cochlear. So I'd be leery of any of these vulnerable high PE stocks. So as usual, what we see as the biggest risk going into reporting season is really foreign exchange. So this Forex is a monster for us. I mean, well, all these companies, as far as the large cap, are net exporters, so they're very much exposed to that dollar. As you've been hearing, the Aussie dollar is hitting new time highs, but that's a fiscal 18 headwind. Looking in 17, the AUD USD cross is up 3%, to about the same in the second half. So that is clearly a headwind for these reporting companies, US dollar reporting companies, as well as Aussie reporting companies. So I'll be very cautious here going into reporting season. Just looking specifically at the stocks, and you can see them on your list here. We'll start with specialty pharmaceutical companies, CSL. Really believe that their guidance is achievable in 17, looking at 18 to 20% NPAT growth. Consensus is a little bit above that, and I think they can come in actually and surprise to the upside there. However, it's really fiscal 18 where I'm actually more concerned. Consensus is sitting at 21% growth. I'm at 15%. Recall last year, CSL, we were sitting in a similar position. CSL pulled out 12% growth. Consensus was at 18. The stock fell 5%. So perhaps we're in for a little bit of a deja vu here. So I'm definitely leery of getting into the reporting end of year with CSL. Now we pulled this thing stock back to a neutral at 142. It has come off that level, obviously, sitting at about 130. But I'm definitely looking to pick this thing up around the 120 range. I think it's a little toppy still at 130. Moving on to the private hospital operators, we have Healthscope and Ramsay. You know, for Healthscope, I've talked ad nauseum about this name. There's a lot of known unknowns, I would say, for this. You know, we have a new CEO at the helm. We have still soft utilization as far as private hospital operators are concerned. The affordability issues are ongoing, obviously in the press, and brownfield progress, really the key things to look out for there. So there is definitely risk, as I said, heading into the year-end result. However, I've always had my thesis and maintained it, and I'm still maintaining it. The underlying fundamentals are still strong, unwavering. Their brownfields are on time and on budget. It's really an 18 to 19 fiscal year story on those uplifts as far as their earnings accretion, and actually have them growing faster than Ramsay in those out year numbers. So happy to be there on a medium longer term view. Ramsay should really consistently have its form. Really, the guidance looks reasonable. 12 to 14% is what they're calling for on their core NPAT line. Everyone's roughly sitting in that range. Solid base business, but you have really offsetting the headwinds from the rest of the world. This is their UK and France businesses. Very challenging, although they're holding their own. So still like Ramsay, but I'm really pounding the table here if that stock actually fell around the $70 mark. We're going to turn really quickly to ResMed, a medical device company. They really kick off earnings season for us. They're going to report their quarter, their Q4, that is next week. Really trying, I would say, to forecast the quarters for ResMed is akin to trying to forecast the weather. It's very, very difficult. There's no guidance they give you. There's very, very little visibility, but I am leaning more positive than not. We have the beginnings of a new upgrade cycle as far as their new product lines are launching. They have their accessories that were stumbling for supply issues, so they're being right-sided. You have also modest really hurdles as far as their comps. Their comparable quarters didn't seem that difficult. So net, I'm pretty positive on ResMed. I'd say the analytical platform on their healthcare IT is still a kicking goals and going strong, so I'm happy to be there as well. And lastly, I'll point out Certex. Now, this has been an interesting story for us. I mean, it has pre-released its top-line results. This is a device units to treat liver cancer. So it really should be an in-line year-end result. However, going forward, that's where the risk is involved. They had a recent organizational changes. New CEO has come in. There's really not a viable strategy as yet. I actually sat down with the CEO yesterday and talked to him, and he's not really willing to come out with any definitive plans until November. So when I look at this stock right now, it's trading at 16 and a half bucks. I picked it up at, I've been sell rating on it for as long as 4 years. That thing has played out. I picked it back up at 10.50 as a buy. Now letting at 16.50, I'm willing to take profits here. I don't see why you really want to be in this name until he really flushes out a viable, credible strategy. And like I said, that's not going to come until November.